most common mistake of investing. Thinking that the investment that did good is a good investment. There are three things that are going on now, the two great extremes that have not existed since the 1930 to 45 period. And it's important to know those three things and then to understand them well. The first is what is going on with money and credit when you get to something like a zero interest rate and you need buying power. The government needs buying power, but they can't tax it. So what we have is the production of a lot of debt that the central bank prints money and buys that debt to spend. And the last time that happened, in the last few years, it happened starting in 2008, interest rates hit zero. They couldn't lower their interest rates. So they had to print a lot of debt and the government went in and bought it. Okay. And we're coming to the end of a debt cycle. Okay. So this is a big thing, because where does the money come from and who will get what? The government will now determine that, and then they'll print it and it'll devalue money. Okay. And how money flows, a big deal. So that's number one. The second one are wealth and political gaps that are causing great conflicts. Throughout history, there's always been the main things that everybody's always fought over is money and power, particularly political power. So what we have is a situation when you have a large wealth gap and you have an economic downturn, particularly if you put a lot of debt having at the same time, you have a fight. I mean, that's been true through history. And it's reflected in the political gap. So the political gap it's classic political gap. Left, right, capitalist, socialist. Well, how do you distribute it? How are you going to deal with that? And that becomes the other. And how you fight. So that's the second of the two, this wealth political gap that's causing the conflict. And it's coming at a time where we don't have much money, because we don't have a good financial position. We're printing and putting it out with made up money. Meaning what happened, like COVID was such a good example. A lot of people and companies had falls in their income that would be ruinous. If checks didn't go out, we would have had a revolution. And so those checks, and how do you save everything and so on? Okay, and it's not like the government had real money. So they made more debt and then the Federal Reserve printed it, the checks went out, which diminishes the value of money and so on and changes things. So then the third thing is the rise of a great power to challenge an existing great power. So the rise of China to challenge the United States. In all history, there are world orders. What that means are the dominant power. It's like in nature almost, so the big bull or something. Anyway, there's the dominant power. And then what happens is in 1945, we entered the American world order. The United States won the war. And then in 1945, the winners of the war carved up the world. We had 80% of what was considered money at the time, gold, 80% of the world's money, essentially. We counted for half the world's economy. And the rules were set in the United States, basically. That's why the United Nations is in New York. The World Bank and the IMF are in Washington, D.C., because we began the American century. And then we are now at a time, we've never had another power challenge us in the same way. There was the Soviet Union, but they were always a fraction of the size economically, so couldn't compete on that same basis. They had nuclear weapons, but they didn't have the economic power and so on. But now we're dealing with China coming on as a power. I spent a lot of time in China over the last 36 years, by the way, and I admire how they're doing a lot of things. I mean, I know it's controversial to say that, but in terms of they're a power. Whoa, since I started going there, their average income has increased by 30 times. So they're a comparable power and they're also growing faster. And so that has an effect. So those three things are things that never happened in my lifetime before, but happened before in history, which led me to do the studies of what happened in history and the lessons I could gain. The most common mistake of investing. Thinking that the investment that did good is a good investment. People rather more expensive. The things that quite often, those markets that did really, really well became more expensive, and everybody, smart money is all the time comparing them and competing. So what happens is the naive money buys the thing that was hot or is hot. The thing that has been terrible, which might be the thing that's beaten down. So I would say also an important element, diversify. Because what I learned about this is that, first of all investments compete. And it's not easy to tell whether one investment is better than the other, because if people could do that, life would be easy and everybody'd make a ton of money. And this is a competitive game that's very difficult to compete in. So it's very difficult to say which one's better or worse. You can take experts and do all sorts of tests, and you'll find out that they can pick that, and you can't tell whether the worst ones are going to be better. So because of that, you understand that even picking the best ones is difficult. And particularly if you're naive, like we spend hundreds of millions of dollars each year on research to try to give us an edge. Wow. Okay. Now you've got to compete with us. So competing in the markets is more difficult than competing in the Olympics, but there are more people who try harder in order to do that. So it's a zero-sum game, but diversification will reduce your risk without reducing your return. So if you know how to diversify well, that's critical.